I think the signal, the important signal is that it's a pause, not a pivot. They're still on the guard in terms of risks from El Nino, potential rise in oil prices, Fed. So they're not letting the guard down. But at the margin, the economic conditions, I would say, are more sort of Goldilocks, in the sense that growth is resilient, inflation is down, oil is down, current account is well managed. So good position to be in, but not yet letting the guard down.
And so what would change the course for them, you think, in the next 6 months? Because obviously we are debating right now rate differentials, we're debating on how that changes with the Fed's policy view, and whether the Fed also pauses or not, and what they do from here. And so in that light, what do you expect to be the triggers for determining policy in India?
So, I mean, our view is it's going to be an extended pause from here. So the direction after that, obviously, it's either a hike or a cut. We think the chances of a hike are pretty less because we are entering an economic cycle where domestic demand is going to slow. And while there are risks from El Nino, aggregate inflation pressures, both in terms of supply and demand side, are actually cooling off. So compared to their 5.1 inflation projection, we think it's actually going to undershoot and be closer to 4.7%. So we don't see any need actually for a hike. Therefore, the question is more in terms of the timing of the cut and when it happens. The main thing our view RBI is looking at is El Nino and whether it has a negative impact, and that clarity we will have in the next 3 months or so.
To the monsoon season, yeah.
Absolutely. And beyond that, if we continue to see signs of core inflation decelerating, domestic demand softening, which is our view, then we do think actually there will be a pivot by the end of this year towards a cut.
Okay, towards a cut by the end of this year. Could the RBI do its own thing, or how much of that would get determined by the Fed? Could it come ahead of the Fed and do a cut?
We think it can actually come ahead of the Fed. The main risk, of course, is from the external sector, but on that, things do look more stable. So current account deficit is tracking below 1.5% of GDP. We have more than enough capital flow, so it's a balance of payment surplus. Rupee, actually, the pressure is towards appreciation, which the RBI is not letting happen. So there isn't actually a problem on the FX side. So ultimately, it's going to be driven by domestic growth inflation considerations, and that essentially should, in our view, be signaling a softening stance as the months progress.